Ladies and gentlemen, thanks so much for tuning into The Scoop. I'm your host, Frank Chaparro. And what crazy times we live in. I mean, today is Inauguration Day. We weren't planning on recording today, but we had some technical difficulties on my end last week with Tony at Cambrian Asset Management. So now, Tony, you've got almost a new world around you compared to just 72 hours ago. Maybe walk us through sort of like the firm, your role there, and then we can get into everything that's happening in the market.
Thank you, Frank. Well, it's an honor to be on your podcast, and it's an honor to be amongst the first, I guess, in this new presidential term, whatever that may or may not bring us.
Yeah.
Cambrian is a systematic long-short fund that is entirely crypto native. That's all we do is invest in digital assets. And we've done so since 2018. So I think we're one of the few dedicated liquid strategies that has a 6-year track record. We are mostly on the West Coast, but like most firms, we work remotely and we have some colleagues on the East Coast and in Texas. And we are very, very focused on dedicating our efforts to the liquid space. We have a team of engineers that works very, very hard at trying to look for signal and really pass it out from what is a very, very noisy ecosystem.
Very noisy.
And we are, obviously the developments of the last 3 or 4 months have been very constructive, but have really operated outside, if you like, the focus of our internal efforts, which are, essentially looking for signal, looking for ways in which we can find some ability to predict, even if only in the very, very short term, market moves. And we want to be as agnostic as we can with respect to the token. So no one at Cambrian really reflects in the portfolio any discretionary view of any token or any cohort of tokens or anything that is related to supply profile, mining methodology. We have one of the great insights that we've been able to translate into what we do comes from what happened during the early days of the internet, whereby what looked like the early winners were definitely not the winners in the second, third, and fourth innings or stages. And so we want to be allocating capital to what are the successful projects, and we take market cap of those projects and liquidity of those projects as an indicator. So I've sort of gone a little bit around.
That contextualizes it really well, and there's a myriad of specific highlights that I just want to bring to the surface of what of your sort of outline. The first of which being, you're right, we don't have a lot of liquid market participants on the show, simply because there aren't a lot of them. You mentioned there's not a lot with a 6-year track record. There's not a lot with a 2-year or 3-year track record in this space, and there's a whole host of idiosyncratic aspects of crypto that stems from the lack of there being more Cambrians. And I think you mentioned on our prep call the volume you guys are doing. I don't know if you want to specifically say that on the record, but it speaks to how few there are, right? Because you're doing a lot of volume with exchanges, on exchanges. So that kind of leads to this second interesting point, which is, again, the conversations are much different because they stem from folks who come on or are in market with sort of these long-term theses, right? Like we had Brian Watkins on the show to outline why he thinks Solana is undervalued relative to ETH for XYZ reason. But where you can come in, where you guys come in, that's super interesting, is it's more about these weird, thorny sort of dislocations in the market or market inefficiencies that you're able to capitalize on via the sort of the data that you have at your fingertips. Is that a fair way of putting it?
Yes, I think it is. To be clear, the reason why we're in this business and why Cambrian was founded is that we're constructive on the ecosystem. We're believers in the underlying technology, and in particular, we are believers, firm believers in the roles that tokens play as incentive mechanism and reward mechanisms in operating blockchains. But what know, we kind of know two things with a relatively high degree of certainty. The first is we know that we don't know who the winners are going to be. Um, and then the second is that we know that there are going to be significant drawdowns, irrespective of long term views. Since we've been in business, there have been 50% drawdowns in the overall market. And a 50% drawdown really punches any kind of compounding arithmetic in the teeth. And
Yeah.
so if we can cushion those drawdowns, and we're very, very focused on downside volatility control, if we can cushion those drawdowns and try and rein in as much of the upside as possible, I think that we're able to compound at a significantly high rate net of all fees over the long term. And so that's what we're really trying to do. I think there are some very, very good and insightful players that do try and pass out value, not only absolute value, but also relative value between the tokens and the various cohorts of tokens and use cases and so on. But that's not our skill set. Our skill set is really taking what quite a few of us have learned from traditional markets, applying them to the crypto markets, which is hugely challenging because, I mean, if you compare systematic investors in fixed income, I mean, they, in some cases, I mean, I worked for a firm that we had something in the order of 250 years worth of fixed income data. We really, I mean, we have a comprehensive data set, but it goes back to 2014, which is relatively recent. It's somewhat made up for by the fact that tokens trade 24/7, but this ecosystem is it's very easy to overfit. But that's essentially what we're trying to do. We're trying to benefit from the long-term expansion, but by making sure that we're allocating to the winning projects as we measure them by market cap and and by trading volume. So, as an example, when we first started, I mean, almost the majority of the capital was allocated to Bitcoin, to a Bitcoin trading system, and then over time we started allocating more to Ethereum, and now we have a significant amount of capital allocated to the Solana trading systems. And so, and we really did not know that that was going to be the case. I mean,
Yeah.
we reacted more than we predicted.
So maybe we can do two things. Let's look at this past weekend as like a test study of your overall sort of participation in the market, and then hit those high level themes. I mean, you're looking at a situation where, again, it's still the markets aren't opening until tomorrow in the states for U.S. equities and bonds because of the holiday. And over the weekend, you had the rollout of this Trump meme coin that had massive impact on the overall market, in terms of Solana skyrocketing, and then kind of some cracks emerging as the volatility really gripped the entire crypto ecosystem. So, from the perspective of a fund like yours, uh, where you have, I mean, billions of dollars trading on a weekend and a lot of uncertainty, a ton of volatility, what does it look like? How are your systems reading the market during a weekend like the one we're just getting out of?
Well, it's fair to say that our systems and our approach is essentially built precisely for these kinds of environments. I mean, it is part of the robustness that we look for when we're stress testing a model, that it can react in a dispassionate way to information that it's garnering. And we take information, we only trade spot markets and we only trade in the US. And obviously, some of the big things that have happened in crypto have been very US centric, going back to the launch of the ETFs and so on, which have been of huge benefit to us because we've only traded in the US. But we take signal from both spot markets and importantly from leverage markets around the world. So we only express those views, if you like, or the models express their positioning only through spot. But we take signal. And so volatility is not new. Big swings in prices are not new. And big sell-offs and build-ups of leverage and so on are not new. So honestly, there was nothing particularly new from the operating of our set of models. We have 6 models. They all do something slightly different, in some cases very different, but all something different. They all have a slightly different composition of assets that they trade. 2 of them go long and go short. And so the combination of those models tend to react somewhat differently to what's going on. But in many ways, it was business as usual. So there's nothing, obviously, when we look from the outside, we see these, we see news, or we see one particular token that explodes, or one particular token that explodes with a commensurate negative effect on another. That is really something which, because we are dispassionate and we have no views, the models simply react in a cold-hearted way to the data. And
So how did the models react? The models see maybe sentiment on Twitter turning more negative, and they react accordingly. They see trades, maybe positions being put on in leverage markets, and they react accordingly. What are those? What are those chain reactions?
well, the changes typically are only very marginal. We take snapshots of one of the benefits. I mean, we make very, very comprehensive use of machine learning. And one of the things that helps us do is take very, very frequent market snapshots. And so we adjust, and we want to be in a position to adjust marginally very often, as opposed to facing these step function changes and big reversals in a portfolio. But the inputs are market data. So we don't measure sentiment. So what happens on Twitter to us, to the extent that it has no effect on price and or volumes or on combinations thereof, is not really very, very interesting to us. What is interesting to us is price moves and volumes in many complicated calculations that accompany those. And so I will tell you, over the last actually 24, 36 hours, we have not changed a huge amount.
Mm.
There's been no major change in the portfolio.
You basically, you're basically noting that the approach to crypto markets hasn't changed significantly, but how have you maybe noticed changes within the market itself? The models are agnostic. They're sort of set in stone relatively, but the market's a lot different. So, whether it's more liquid from the rise of ETFs, how do you see, whilst the models themselves are sort of these pillars, how have you guys noticed the market dynamic or market behavior changing, especially given ETFs rise?
Yeah, that's a really good question, and it's actually very interesting. So if we step back, we believe very strongly in behavioral biases, and we think that they're absolutely prevalent, in particular in crypto markets, where people's ability to define value is very complicated. It's challenged, and people use many different approaches. But if no 2 people can agree on the value of Nvidia, as an example, no 2 people can really agree on the value of Bitcoin or a smaller token. So that allows for the expression of behavioral biases. What has happened really over the last year or so is that the ETFs, which, by the way, the most successful ETFs launched ever, the introduction of players into this market that we would have never have thought possible. I mean, who would have thought 3 or 4 years ago that Franklin Templeton, BlackRock, Fidelity would be dedicating significant resources, both material and reputational, to this ecosystem? Um, but what it has also done, and the ETFs, they really are, for the most part, a retail instrument, has essentially brought a new cohort of investors into this space. Investors that didn't want to concern themselves with custody, that wanted to make sure that they were dealing with a instrument that they could have in their brokerage accounts and so on. So I think that it has brought in a new cohort of investors, as well as an ability to engage in quite a lot of financial engineering. So a lot of, I would imagine, hedge funds will look at arb trades between, MicroStrategy and the underlying value of Bitcoin and so on. And so all this new involvement in many ways exacerbates the signal that we trade. So it's been of huge benefit to us because essentially the more and the more different types of players engaging in this ecosystem, the more unsettled it all becomes, and the more fruitful, if you like, will engineering be able to find consistent and predictive patterns in the data, which are helpful to us over time. I mean, obviously, in the short term, they may or may not be work, but we look for signals which have economic intuition and then have consistency in their application, and have some predictive element to it. So it has been very, very, very helpful, along with all this other signals that the increased participation of high quality players bring, which and I'm sure we'll talk about it, is in the area of just overall regulation and perception about the regulation.
Yeah, that's literally the next question I was going to ask. So a perfect tie-in, dovetailing off of that. How do you anticipate, regulatory changes or regulatory clarity, which in my perspective will likely mean larger institutions, specifically though, like prime brokers and our capital markets, being able to touch crypto, Bitcoin via custody, via credit for the first time? How does that impact volatility or just the way our markets function? What are you folks anticipating for the next year as these firms penetrate crypto?
Well, you've touched on it, and we're really coming out of a period of remarkable regulatory hostility, and I think sometimes it's semi forgotten how, in particular, I mean, obviously 2022 very difficult, starting in the first quarter with Three Arrows and Voyager and so on, followed by FTX in the fourth quarter. But I think that the death knell, I mean, I don't want to exaggerate, but what was really impactful was the crisis around the three banks in the first quarter of 2023, Silicon Valley Bank, Signature, and Silvergate, because that really made it very, very difficult for anyone with a fiduciary background to think about this space without being very cognizant of potentially their investments being cut off from the banking system in some form. So that's a big, big difference. So just the reduction of any of that kind of hostility is just a massive boost. And then if you add to that actually potential tailwinds, you're going from a situation where you've had headwinds, you might actually have significant tailwinds.
Yeah, that's a really good point. I was talking with a founder this morning. She, has been in stealth mode for a while, and she just wanted to like run a tweet by me about the change in tone. And the feedback I gave to her was, I think your tweet is not 100% reflective of the shift, because the way you're framing it is we went from negative to good effectively. don't need to get into all the details. But the point I made to her was we're going from very, very negative to almost too good, where it kind of to harken back to the Trump meme or quote where he says you're going to get tired of winning. It's not the case where we're going from good to bad or bad to good. We're going from very, very bad, almost destructive to they're literally Tony launching their own meme coins. So this is I don't want to pontificate ad nauseum too much, but the tone shift is almost undescribably positive.
It is, and it's interesting that you were talking to a founder, because I think that ultimately, the reason why this ecosystem exists is because there's a very, very exciting potential technology with a series of very, very potentially very impactful use cases. So that is what, in the long term, is going to create an ecosystem which, from an investment standpoint, you're no longer going to be able to ignore. But one of the very important things in the US in particular is that founders have been forced, if you like, to rein in their development efforts, or have had to go offshore. And anecdotally, we're hearing quite a few returning. But let me give you a thought experiment. Imagine, and this is something which has been mooted, imagine that there is some safe harbor created from a regulatory perspective that allows for, let's call it a sandbox environment in which tokens can, projects can launch, tokens can exist, and they're not necessarily assumed to be bad actors from the get-go. And there's a period during which there is some regulatory standoff before there is some clampdown as to whether they're securities or not, right? Imagine you had that safe harbor. I mean, how powerful would that be for developers? Because there is no doubt that a lot of the developer work, admittedly, there has been a shiny new object in the world, in the form of AI over the past couple of years, and with some very successful consumer-driven use cases. But for developers to be able to have some safe harbor in which they can launch projects, I think that could be a game changer for you know investors and practitioners to really accept and understand potential use cases. That could be a huge, huge difference.
And this might be one area where we finally see that change in the market result in change at the firm because whilst the models are pretty set in stone, the token profile can now expand, and we could see not just an expansion into the long tail, but also a broader diversification of the portfolio. Um, how do you see? I guess the question is the balance changing, and and walk us through like the when you think about you I wouldn't say onboarding new tokens, but you entering new token markets, what boxes need to be checked? And the reason why I ask that question is because I think it's important when we think about the growth of each individual asset's capital markets. For Bitcoin, or rather for new tokens outside of Bitcoin, ETH, and Solana, is it market cap? Is it the addition of new spot ETFs or derivatives? Is it trading volumes on exchanges? Because I think once a firm like yours starts to trade a new asset, it really almost in a way isn't a stamp of approval to go buy it per se, but it does signify a level or degree of maturity.
Well, I hope no one takes us trading trading a token as any kind of investment advice. There are two. I'll answer the question in a slightly different format, which is why would we not add a token to our trading universe? So you mentioned market cap and trading volume. That's exactly right. But what we do is we allocate, if you like, capital to the various tokens inversely proportional to liquidity risk, because there are many tokens that have huge liquidity for short periods of time, and it can be very stochastic. And so that doesn't work for us. So there has to be some consistency. But there are two reasons for why we would not, assuming that a token met, minimum numbers, if you like, in trading for us to allocate. There'd be two reasons for why we might not include them. The first is if there's any kind of regulatory risk. We don't have, and we don't want to have, appetite for judging that regulatory risk. So to the extent that there is some question mark over a token, and it's happened once or twice, Terra Luna being an example, we just eliminate it from our trading universe. So regulatory risk. The second is what I'm going to call technical or technological risk. If there's a token that, like possibly Ethereum Classic, where there is some significant, there'd been quite a few Sybil attacks. And if the technical, technological risk becomes a bit too high, we'll just eliminate that. And that can sometimes happen. It's happened with 2 or 3 tokens, but they typically tend to be small tokens. And just to give you a sense of magnitude, prior to 2022, there had been a period where we would have traded, our universe would have been something in the order of 70 tokens, 70. That shrunk a lot in 22, 23 as a consequence of declining volumes. And it's begun to expand again. And I think last month we traded something in the order of 30 tokens.
It's interesting. It's like almost a behind the scenes sort of, and I hope I'm not overstating it, but it's a bit of alpha there because it illustrates a comfortability level that maybe is a leading indicator of where the market is, or sort of the, again, just going back to that word maturity.
Yeah, I mean, there are periods, and I think that many work on, if Bitcoin moves, then the so-called altcoins move, and if the Bitcoin moves X, then the altcoins move X to some power. That happens sometimes. It doesn't happen always. And so for us, what we're looking for things is that things that typically happen often enough on a probabilistic basis for us to want to, if you like, speculate on that particular movement. But what is interesting, now that we're talking about the altcoins, we were very careful when we first launched Cambrian. We wanted to make sure that we built a track record that when we talked to investors about it over time, we felt that it was sustainable. And obviously, if you start a firm in 2018 and all your returns are from tiny, tiny tokens, that is not a track record which is sustainable. So we actually took the opposite. We said, let's start off with the most liquid, and then over time add the less liquid. But what is interesting with the altcoins is that Ethereum emerged, if you like, out of the second to last bull market. Solana emerged out of the last one. And there is nothing that has emerged significantly as yet in this next iteration. So it's going to be interesting to see if that pattern repeats itself. But you tend to have an emergence of a different token after a significantly favorable period of market activity. And we have not seen that as clearly as yet, relative to other periods.
That's a pretty good point. So yeah, just let me know once you get back to like 70, 80 tokens. That's when I'll take some risk off the table, probably. Another thing that we've talked about on this show, and we've talked about with you and other folks at the firm, is the active management versus VC allocation in this market, with the former being almost under allocated in a sense. There's far less capital being deployed via systematic funds like yours. Um, what do you think have been the main barriers preventing a healthier distribution between actively managed systematic firms and and this sort of like venture style that also has like a an element because it is crypto of venture and liquid strategies.
Yeah, and you're right to mention that because a lot of venture firms are pretty active in the liquid space. And if you talk to any trading firm or exchange, they will tell you that the venture firms can be very active. In
Yeah,
many ways, you can understand it. I mean, if you think of, I mean, we think of tokens as representing very, very early stage, in some cases, pre-seed projects. They happen to be very, very liquid. Um, so it lends itself in many ways to private long-term investing in concept. I think that the reason for why institutional investors in particular have been hesitant, apart from obviously the regulatory issues that we've discussed, is that, and by the way, most big institutions do have some exposure via their VC or early stage investment. So when investors say that institutions have no exposure, I don't think that's quite true. They may have
sure.
limited direct exposure in
Well,
liquid
but
investment.
the fact of the matter is they don't have. I mean, aside from your LPs who are very brave and handsome, and compelled to enter via liquid, a lot aren't.
You are
And
correct.
yeah, the question is like, why are those impediments there for the vast majority of them?
Well, I think there are two broad reasons. The first is that because they're so volatile, institutional investors don't enjoy taking volatile marks on their portfolio. One of the
Yeah,
wonderful things about a private investment is that there is some
you can pretend
significant
like it's
potential.
going up forever.
Well, yeah, I'm not going to use vocabulary that's going to get me into trouble, but yeah, there is some element of control, if you like, over the price discovery or lack thereof. So there's, you know, when I first joined the liquid market world a long time ago, the saying was, in liquid markets, your laundry is put out to dry every day, and in this case,
Yeah.
your laundry is out 24/7. Um, and so I think that that is, for many investors, not appetizing. The second point, I think, is that it is very, very difficult. I mean, institutions or investors that have a portfolio process, they tend to have, let's call them boxes into which they put various investments. And it's very difficult to find a box for liquid tokens. And so I've talked to many, many institutions that have yet to allocate, but within those institutions, I probably talked to 20 different boxes, from systematic to trading to sometimes venture, sometimes the diversified bucket, absolute return bucket. There's all sorts of potential buckets into which this could go and not go. And so the one thing in common that I have found that's almost every case with an institution is that the person at that institution that is the most interested in this universe tends to be on the younger side. That is the one thing in common. So typically there'll be one protagonist that wants to grandfather, godfather the allocation process, and wherever that younger person lives in the investment framework, it tends to be he or she that pushes it. And there's career risk in that if you're the youngest, right? And so I think there have been a whole series of obstacles that have just presented themselves. And frankly, from an institutional investor standpoint, let's say they, at the most aggressive, they're going to allocate 2 or 3% of their portfolio. They may have bigger problems to solve from a portfolio allocation. And then there is one other thing which I think has been specific over the last 2 years, and I think it's a VC early stage issue, is that there's been just a dearth of distributions, with the M&A markets having taken a breather in tech, and the IPO market drying up somewhat. So the amount of cash that would have potentially been recirculated in order to address some lack in this area has just not been available. So I think all of this, along with the regulatory issue, has just meant that, discussions on this topic have been kicked into touch, and they're slowly coming back again.
Thank you. Amazing. Thanks so much for taking the time. Appreciate you.
Frank, thank you very much, and good luck. Are you at the inauguration?
I was. I left Friday and got back Saturday.
Were you at the crypto ball?
Yeah, I just did one night in DC and attended the bowl. It was quite the experience. I got to meet a cadre of characters from Don Jr. to the Speaker of the House, to Vivek. It was, and that's why I made the point earlier, is that all these folks are not just it's not just it's not pandering. It's like real excitement about where this space can go. Even Dr. Oz was super excited about crypto. I kept referring it to as the coins.
Well, you do a fabulous job for the ecosystem. We need more people like you to do the thoughtful reporting that you do.
I know. If I could clone myself, I would.
I wish you could too, but you do us a great service, and honestly, your work is essential for anyone that's looking at this ecosystem. So thank you.
Thanks for saying that. We'll talk to you soon. Don't be a stranger.
Take care. Bye-bye, Frank.
Mm-hmm.